Tax planning is a crucial aspect of personal and business financial management. By understanding and strategically applying tax laws, individuals and businesses can optimize their finances to minimize tax liabilities and maximize wealth. However, effective tax planning requires more than just trying to reduce taxes for the current or next year. The key to successful tax planning lies not only in understanding the complexities of tax law but also in the ability to forecast future trends, recognizing changes in individual or business financial situations, and adjusting strategies accordingly. Here are the top strategies that high-income earners in Australia might consider. Top Strategy 1. Hold on to assets for at least 12 months. In Australia, if you're an individual, trust and hold a capital asset for at least 12 months before selling, you may be eligible for a 50% discount on the capital gain for tax purposes. Top Strategy 2. Use the Small Business CGT Concessions. If you're a small business, there are several CGT concessions available. These can provide substantial tax savings if you're eligible. They include a 15-year exemption, retirement exemption, 50% active asset reduction, and the rollover concession. Top Strategy 3. Capital losses to offset capital gains. If you've realized a capital loss on the sale of a capital asset, you can use this loss to offset capital gains. If your capital losses exceed your capital gains in a financial year, you can carry the loss forward to offset future capital gains. Top Strategy 4. Invest in your superannuation. Certain superannuation contributions may be tax-deductible and can lower your taxable income. For small business owners, contributing the proceeds of asset sales to your super may have tax benefits under certain conditions. Top Strategy 5. Investment in managed funds or shares. Australian shares often provide franked dividends which come with a franking credit. These credits can be used to offset your tax liability. Top Strategy 6. Timing of disposal. Consider the timing of the disposal of your assets. If you anticipate being in a lower tax bracket in the next financial year, it might be beneficial to defer the sale until then, if possible. Top Strategy 7. Negative gearing with cash-positive assets. Negative gearing is where the costs of holding an asset, like depreciation on an asset, exceed the income you earn from it. These losses can often be offset against other income to reduce the overall taxable income and, therefore, tax liability. Top Strategy 8. Consider ownership structure. The tax implications for profits can vary depending on the structure of ownership, individual, partnership, trust, company. Seek professional advice to determine the best structure for your circumstances. Top Strategy 9. Charitable donations. Donations to eligible charities are tax-deductible. If you're planning to make a significant donation, you could consider doing it in a year when your income is particularly high. Remember, while tax planning can yield significant financial benefits, it is a complex and nuanced domain requiring specialized knowledge. Therefore, it is prudent to seek the guidance of tax professionals to ensure compliance with regulations and the optimization of strategies tailored to specific financial circumstances. The journey of tax planning is continuous, flexible, and ideally should aim at achieving the broader financial goals while reducing the overall tax liability.